Is this a dangerous preoccupation about peak hawkishness from central banks?
Yes, it probably is. And we actually think reading economic data recently, I think it's probably too early. We do see that now we have been, as investors, talking for a long time on the stagflation scenario. So activity is slowing and inflation is actually quite sticky. With this, we do see that inflation remains actually quite stubborn and get more entrenched in some elements. So we think now with central banks front loading and becoming more robust in upping policy rates, we think they will need some time for inflation to really come off and be comfortable to let the foot off the pedal. And that will require quite some months where they will be comfortable enough with inflation. But for financial markets, of course, if central banks make those kind of pivots, that would be quite important. So especially what we've seen with equity markets and in particular fixed income markets and credit so far year to date, the drawdowns have been quite significant. So I think there will be some relief in investors if they think, well, the inflation it has been stemmed to some extent.
Steve earlier was talking about the aspiration for the Federal Reserve to achieve a soft landing. I'm very interested as to whether you think that even is a possibility for the ECB at this stage, given that the situation politically now in Italy has complicated perhaps the ECB's desire to head off inflation finally with more aggressive rate hikes.
Yes, that's a very good point. So I think we've seen last week that the ECB jumped into action. So they came out a little bit more aggressive than what markets had been expected. The economic backdrop for Europe has been deteriorating quite a bit. And then also the clouds with Italy and a war on its doorstep makes it a very complicated picture for Europe. We actually think that Europe is heading into a recession and the ECB will find probably that it's very hard to lift policy rates sufficiently in the face of slowing economic growth. That's also something we've become quite concerned about in the US. So we see in the US policy rates have been lifting quite a bit. And we actually think that it is already biting in economic data. So last week we did see the Philadelphia Fed, we did see PMIs, and those are coming down quite sharply. Remember, we started the year at close to zero policy rates. And we're expected, for example, in the US to be closer to 3.5% on top of a very strong dollar, on top of other financial conditions which are net tightening for the economy. So we became more cautious on risk assets in recent week and actually more comfortable in owning more duration risk, so more government bonds in client portfolios. We think it's very hard from here for long-term interest rates to really get higher, and it also accounts for Europe.